Good morning, everyone. My name is Shalina Begum, Northwest Business Editor, and welcome to our breakfast event looking at the future of family business in 2022 in partnership with Alexander & Co, Beyond Corporate Law and McAlister Family Law. So with more than 5 million family businesses in the UK and a good proportion of those in the Northwest, such as Boohoo, Warburtons and Betfred, family businesses play a massive part in our economy and are certainly a driving force for the Northwest region. Today's discussion, we're looking at safeguarding the business for the next generation, continuity, adapting and pivoting in a new direction, generational and wealth planning, tax implications, and how to manage your business in today's economy. We have a great panel today to explore more, and I'm going to ask everyone to briefly introduce themselves. And I'll start with you, Fiona.
Morning, I'm Fiona Wood. I'm a partner at McAlister Family Law, and I specialise in the financial settlements on divorce, particularly those where there are businesses.
Thanks, Fiona. Jim.
Morning, everyone. I'm a partner in the corporate team at Beyond Corporate Limited. We specialise in M&A work, in particular dealing with entrepreneurs, family-owned businesses and small and medium-sized businesses.
Thanks, Jim. John.
Hi, I'm John McCaffery. I'm a tax partner at Alexander & Co. We deal more or less exclusively with entrepreneurs and family-owned businesses and their owners.
And finally, Tom.
Morning, everyone. Yeah, a little bit different to the advisors, to the experts on the panel, but I'm a family business owner myself. I'm commercial director at Dunsters Farm Food Service, based in Bury. We supply food and drink to a variety of catering establishments across the north of England, ranging from hospitals to restaurants to schools and hotels.
Thanks, Tom. We'll start off with a very easy question here, but to the whole panel. What would you say have been the main challenges, especially in 2022, for family businesses? And I'll start with you, John.
A variety of things from my point of view. So you come out of the pandemic, there seems to be a lot of growth. Globally, because of the pandemic, generally, inflation is massive and growing at the moment. And that has caused significant tightening in margins, particularly within family businesses. Transport costs and cost of commodities are proving to be very challenging. Some of these family businesses pass them on, not all of them. And there is a noticeable trend at the moment that whilst top line is being maintained because of possibly passing on these costs, there may be evidence of a little bit of a slowdown coming in terms of purchasing the products. So yeah, it's currently a little bit uncertain, a little bit unpredictable for businesses out there at the moment.
Yeah, and Jim. Jim.
I think it's difficult to generalise. The sectors that you're in dictate whether you've had a difficult or an easier time during the pandemic. I think actually a number of smaller and family businesses have come through the distressed period quite strongly because they've fallen back on cultures and values and behaviours which underpin that sort of business more than they tend to underpin larger corporates. So actually, I think family businesses are, by definition, better equipped to deal with distressed periods in the wider economy because they can pull together. But it depends on what sector you're in. And as John just alluded to, certain areas have suffered difficulties with supply chain issues. So we act for some family businesses in the building and construction sectors who have had a very difficult time because they are some way down the chain of supply and they have been squeezed. But as I say, for the most part, I would say smaller and family-owned businesses are better equipped in difficult times than larger corporates.
Interesting. Thanks, Jim. And Fiona?
The angle I come at it, I suppose, is slightly different, but a business, and most of my clients who have businesses, they are family businesses, whether it's husband and wife or other extended members of the family or shareholders. And the issue we have is we have to try and pin a value on a company because it's an asset for the divorce proceedings. With the issues we've had with COVID and then obviously with supply issues because of the Ukraine war, it's very hard to actually get a valuation that I suppose not that both are happy with, but that seems reasonable and realistic because the factors are always changing. And once you've actually then pinned down the value of shares, you've then got the issue of liquidity, and understandably business owners are nervous to commit too much money to a divorce settlement when they think they're going to need the money potentially in the business to potentially prop it up with an uncertain future. So it makes settlements more difficult.
Yeah, thanks, Fiona. And Tom, coming from a business point of view, what's been your biggest challenge?
Yeah, I think echoing a lot of what's been said, really, I think it has been a really challenging time. And I agree with what Jim said, in that family businesses can have the culture to underpin and get through these challenging times. They can also be more nimble a lot of the time than big corporates. So we have, hopefully use that to our benefit and our customers' benefit, but we are in the same macro picture as everyone else, and inflation is hugely challenging. The frequency of price rises in the food industry and the extent of the price rises is absolutely, it's mind-boggling, and we're just doing our best to sort of manage that for our customers. But we do have, there are sort of square pegs into round holes in some customer bases, because whereas the private sector can just keep putting up their prices and we all keep having to pay them, so that coffee that was £2.50 before the pandemic's touching £3.50 now when we go out. It's not necessarily the case in the public sector, and those budgets aren't getting matched. So that's where we have the real challenges. We do a lot in education, and that's really challenging. Obviously, supply chain issues everyone's known about. Actually getting stock is harder than ever. It seems to be easing a little bit. The labour market, it's really tight, and we had the battle for HGV drivers, which was a huge impact on our business, and the wage inflation that caused. And now we've got, really across all staff, particularly on the ground warehousing staff, the market's so tight now, which is somewhere we've not seen not in my memory anyway. That's something so hard to recruit, even for sort of entry level jobs. So, with your biggest cost for us being wages, fuel and energy, it is, you can't get away from the fact it's very challenging. But like I think Jim said, that's, that is where I think family businesses can come into their own as well.
Yeah, and Tom, just stay with you. I know, you guys have had to deal with the pandemic, you've had to pivot the business during that time, and now it's a different set of challenges. Do you think having gone through all that makes you better placed to deal with those challenges, you're able to hit them a bit?
Yeah, I could completely agree with that, Shalina. I think it's made everyone, I think everyone on this call, and everyone joining this call probably feels that, yes, we might be worn down by it or worn out a little bit by it, and there's a bit of, tired, you're tired with the challenges, but you inevitably become more resilient as you go through these things. And I think that resilience is the number one thing that's come out of the pandemic now. Some of the stuff that comes up on a daily basis now in terms of price increases and issues with suppliers would have been, show stopping for us, 3 years ago. We would have been like, oh my goodness, it's the biggest issue ever. And now it's just sort of another day at the office, and let's find a way to work around it. So definitely, I think that's true.
Yeah, thanks, Tom. And from everything that you guys have said and all the challenges that are out there, does that mean family business to approach things in a different way? How do they manage their growth and expectations? And I'll just throw it out to the panel. And how do you think family business should be managing future growth? Should they be taking a different approach?
Very much depends on the individual business. Key characteristics of family businesses are generally that they're driven by the personalities and the culture involved, usually being family members. And as a result, each family business tends to be as diverse as families are. The successful ones, as with all businesses, will adapt quickly to changing environments and focus on cash, basically, to get you through periods of high inflation, tight margins. Do they need to take a different approach? Some, which are letting family personal issues get in the way, yes, need to corporatize a little bit more. Others, as Jim alluded to earlier, about pulling together and are able to step up, adapt rapidly, meet the challenges, are doing well.
Yeah. Jim, I know you sort of...
I would say a lot of roads lead back to... Sorry, there's a slight delay on my my line. I think a lot of roads lead back to cultures, values, and behaviours, because those can cause massively strong unity, and they can assist with retention and recruitment of staff, which is a industry, economy-wide challenge. But if you get the cultures, values, and behaviours wrong in a family-owned business, I think the difficulties can be exacerbated because of the family nature of the relationships, and people take things more personally or believe themselves to have a different role in the business to the one they've actually got, or they take umbrage at their brother-in-law being over promoted. There's thousands of examples of this that people see, and I don't know if anyone's ever watched the TV program Succession, which is a massively overblown example of what can go wrong, but it's actually, the reason it's so successful is that it like a lot of these things, it's born out of examples that we see of people with dictatorship. It's like sort of psychological challenges in the way they run businesses, psychopathic tendencies often at the top, and people being promoted in the wrong areas. It's not trivial, I think, to throw that example out there, because some of the things that you see on that televised version are just exaggerated versions of what we see happening. But at the same time, if you galvanize cultures and behaviors in the right way, it can be hugely powerful, I think.
Yeah, absolutely, Jim. And we get personalities playing quite a big part in a business. Are you often seeing you've got the granddad of a business who's struggling to let go, and then the second and third generation trying to get their ideas in place, and there's that push and pull, isn't there?
Yes, that the whole notion of succession. If you're an entrepreneur and you own a business and you've grown it and it's your baby, and then you sell it or you pass it on to the next generation, that's intrinsically difficult. When you throw in the family dynamic as well, where the next generation may have different strengths and weaknesses, different ideas of progress, the economy may have changed, so the new entrepreneur will have a different take on what it will take to succeed in 2022 to what it took 20 years ago. It can be a real challenge, for sure, and it can pull businesses apart. We acted for a business last year which was grown by mum and dad to a very successful large construction tarmacking business. They got to the point where they were still running in their 80s. Their sons were in their 40s, but hated each other, and there was no way to fix this mismatch of expectation between the sons, and the business had to split in two. So yeah, I mean, there's no fix to all of this other than to recognize the challenges in family businesses, but the fact that if you get it right, it can be hugely powerful. We would tend to advocate putting in place frameworks, agreements, family councils, some sort of structure of legal agreement making, which can set a framework within which people can act. But that of itself is not, it's not a panacea for all of these difficulties.
Yeah, and Fiona, you work with a lot of family businesses, and you're alluding to shareholder agreements, and sometimes there's prenups as well, isn't there?
There is. I mean, if I start with shareholders agreements, I have to say the vast majority of divorces that I've done where husband and wife are both shareholders in a company, and there may be other third-party shareholders, there isn't a shareholders agreement. And in the few divorces I've done where there have been, they've been extremely helpful, because they say what's meant to happen to the shares if one of them leaves. And in some cases, they even tell you how you're meant to value those shares, which actually creates a lot of certainty within the divorce, and allows people to kind of get from A to B in a divorce much more easily. In terms of prenuptial agreements and postnuptial agreements, again, if people are actually thinking about those sorts of things, they can be extremely useful and a good way of protecting a company, whether or not your spouse has shares in that company. It may well mean that you can even ring fence the company and that not be part of a divorce, depending on what other assets there are. So whilst it may not sound like the most romantic of things, they are becoming much more common, and the courts are now far more keen to uphold them. And again, it stops you having a very acrimonious and perhaps protracted, expensive divorce, and gives a level of certainty which most people who are getting divorced would like to have.
Yeah, is that something that's getting more popular? Are people just now considering prenups and shareholder agreements? Because you start a business and you're not thinking about all that. You're just thinking, I want to grow this business. I want to create, a legacy for my family, and then all the other details sometimes they're not considered.
I mean, I think a lot of people develop things organically, don't they? And I think relationships also develop organically. And many of the family businesses I've seen, there is often one quite powerful personality within it, and whether or not they're the main shareholder, they're still the person with the power, as it were. And often I think they don't recognise the need to maybe document things a little more formally. Often because they haven't got time, and they're quite excited about the prospect of growing their business and doing all the other more essential parts of business, I suspect, in terms of making sure it develops and makes money and grows. But I think a bit of housekeeping, I know it may sound a bit boring getting the lawyers and the accountants involved in that level of detail at the beginning, but I think it can, a small amount of time there would make quite a big difference, whether you have a shareholders dispute in the future or whether there is a divorce that impacts the business.
Yeah, and time to go into your family business. It's been going 60 plus years, started by your granddad and then your parents took over, and now it's you and your sister. How did you guys manage that process of succession planning and and now your role in the business, and are your family still sort of working with you, or have they taken a sort of hands-off approach and it's just you and your sister taking the business forward?
Well, I think firstly, Shailene, I think it's never really done. It's always a journey with a family business, and you've always got to be looking ahead. And that's what I think, the ones that are, successful, or at least the least stressful, we're always doing. They're looking around the corner, and we've been on both ends of that spectrum where it's not been planned at all to we've come a long way from there to where we have got a good level of planning. In terms of the family involved in the business, is myself and my sister really run the business on a day-to-day basis, and we joined together probably around 7 years ago now. Since then, we previously to that, I suppose we both had our own careers and came into the business, but that was where there was no succession planning at all. It was a taboo subject, which is often the case in family businesses. We were pushed to go and do our own thing and get our own careers, and not to be kind of forced into the business. So, but actually, it probably would have been better if it was discussed and planned. But since then, we were both in the kind of corporate jobs and corporate world, so we've tried to bring some structure and the best elements of that into a family business. And like I said, it's always work in progress. You're never there, you're never perfect, and you can always do things better. But that's what broadly, that's been our approach. So we've gone from having no planning and no structure to having good advisors on board, and I think that really is important. And for family businesses on watching this, I think you might think it as an expense you don't need, or something that you can do later maybe, but I think the peace of mind it brings to have a plan and to understand what would happen if this happens, and to have that is remarkable. So we've formalized the overall structure of the business. We've got shareholder agreements in place. My dad and my mum's retired really now, because that was what she wanted to do. She'd been working in the business since she was since a teenager, and so she'd done her fair time. And my dad is still involved. He's like our kind of our chairman, but he's actively involved day to day. He's still interested in the business and still enjoys working in the business. So there's three of us really who work together, but we've got the agreements in place. We've got the links to the relevant insurance documents and policies that should something unfortunate happen to one of us, that the business can continue to provide stability for the business and for our employees. And we've also worked a lot on the actual structure of the business, how that works to make it future. We've grown fairly rapidly in the last 7 years, and we need to make sure that we're always fit for the size of business that we are, and we're not behind. So we've recently made our first non-family directors appointments to the board. Well, we first made a non-executive director appointment, which was great, and I'd recommend that for people who are interested in doing so. And then we made some family director appointments, and we have now a dual board structure where we've got kind of a family board, and then we've got the day-to-day management board beneath that. That's very new to us, but it started really well, and it works well for us.
And what this conversation is quite scary to have in the first place. I mean, it sounds like you're in an ideal situation now where you've got the structures in place, but having those initial conversations can be challenging, can be a bit scary, especially when, like, you know, the first generation haven't thought about it.
Yeah, I think so. It's the manner and the way you do things. I think I've learned a lot in the last 7 years. You know, I've got to be patient. You know, I've had to be really, really patient with these things and have a plan, but not be too, you know, as long as we're moving in the right direction, kind of be happy with that. So it is about the way you approach things. And I think it's showing the benefit of everything that you're doing as well. So you want to be able to show the wins, and that quickly gathers support. And that's the place we've got to now, where we've done it with a structure, we've done it with proper advice, and we've got those wins, you could say, under our belt. So now, you know, everyone's kind of in the same direction, which is where we want to be, and I'm really pleased to be. But it's not without its stresses and trials at the time. It's not to say it's easy sometimes.
Thanks, Tom. And talking about, you know, family planning and, you know, future wealth and growth, John, just talk about, you know, how, you know, businesses can protect their wealth and, you know, and grow the business in a more sort of tax efficient way.
Yeah, it's the family business is really interesting for that, because the personalities do actually dictate ultimately how you structure the succession and the wealth planning. Basically, there's a bit of a playoff here. If you are a shareholder in a trading company, if you die holding those shares, there's no inheritance tax on them. So there's a lot of, as you say, the grandfathers holding onto these shares, not paying inheritance tax, and there's a step up in the capital gains base cost. So you wipe out all historic capital gains. Now that can run counter to the fact that there's generations coming through who want a piece of the action holding onto the shares. And in those circumstances, if they buy those shares, you end up with a whole inheritance tax problem for the older generation. The next issue I frequently come across with family businesses is they're quite organic in the way they build their business. So if they're successful, they tend to find that there's a load of surplus cash in the business, and they'll start punting it into property and investments and loans, and the whole trading nature of the business disappears for tax purposes, and then exposes the whole business to an inheritance tax problem. So then you've got to look at how you separate out the business into its trading and non-trading elements, and then pass it down the generations. Other problems is shareholders or first generation shareholders who have 3, 4, 5 children. A couple might be in the business, a couple might not be. The couple who aren't want their share of the value. A couple who are end up fighting over the fact that they're driving the value. And that takes some pretty careful structuring in terms of making sure that the business can continue to function, which is where shareholder agreements and article drafting from a legal point of view is particularly important, whilst also making sure they can pass on the value to those other non-working shareholders. Other structures that frequently work, the Duke of Westminster uses, is it's got to be in the right circumstances, but you can put certain businesses, or you can put all businesses into trust structures. So a trust with trustees operates elements of the business for ongoing benefit of future generations, with all family members benefiting as beneficiaries. They're not the most tax efficient structures. They work well from an inheritance tax point of view, but it is a structure that is quite equitable in terms of the fact that there is a legal separation between the benefit and the legal ownership. So you can end up in a situation where the trustees are responsible for the correct running of the business, whereas the beneficiaries are off to one side. So it's very much a bespoke service driven by the specific circumstances you find, and very much the personalities as well.
How about family investment companies? Are they still? Yeah,
family investment companies. So family investment companies are interesting. They are a little bit different from family businesses. So a family investment company is a pretty decent way of protecting wealth, and keeping future growth in your wealth outside of the IHT net, inheritance tax net. Family investment companies are basically a company whereby you use the company structure to make investments. So it's often used for surplus cash or property or that kind of thing. And either there's a class of share held either directly by future generations or into a trust structure for future generations, which represent the growth in the underlying investments. So the first generation, say, puts in some value, often creating a loan owed to them. They might put in some cash, they might put in some property, and then that value is frozen in, say, an A class of share to them, and then the B class of share will go to a trust, and the growth in the value of the properties, the investments, that kind of thing, that can go to this trust. And again, it's the trust structure is frequently used to protect. It offers a level, and Fiona can comment more accurately on this. A trust, right? If a beneficiary held shares directly, that value belongs to them, so it's up for grabs in the event of a divorce. If it's in a trust structure, it offers a level of protection from outside influences trying to take some of the family wealth.
Yeah, you wanna?
Yeah, certainly it does depend on the trust. And the recent case I've been working on, actually, my client is only entitled to the income from the trust that owns the shares in the company. So in that sense, the actual capital value, he doesn't have capital value in the business, and therefore that's not an asset for divorce purposes. Even if the capital value is part of, it's still, normally they're set up as discretionary trusts, and it would then depend upon how much he'd actually received from the trust in the past in terms of, so there'd be a kind of historic element to it. So if the trust wasn't that generous and didn't give large handouts, it would be hard to say that, well, as soon as he gets divorced, he'll be able to get a large chunk of money from the trust. So it's correct, it does protect assets to a certain extent, depending on the nature of the trust in a divorce scenario.
Are there other ways, family businesses can protect their assets? Is it mainly just shareholder agreements or the prenups? Is there anything else that they can do to make sure that they're protecting their wealth?
Not really, not the way our divorce law is at the moment, because I think really all the assets that a couple has an interest in are kind of fair game as a starting point on divorce. So a prenuptial or postnuptial agreement, I think if you coupled that with a shareholders agreement, and it would again depend upon you can ring fence business interest in a pre or post-nuptial agreement, but if that is a huge value and the other assets that a couple have are very small, you're not really going, a judge will still say, well, we need to attack some of this money or use some of this money. So in that sense, that's worth doing. But I think then the shareholders agreement, so if you do have to look to the shares in the company and include that in the divorce, if that is quite straightforward, and in terms of what happens to the shares if one of the shareholders has to get rid of their shares, or how the shares should be valued unless there is a sale of the business or a flotation, which are separate issues, then I think it's worth doing that. I think on the whole, the biggest problem that most divorcing people have who have their own company interests is that it's a large asset. It's often disproportionately, it's normally far over 50% of all the matrimonial assets. And they've got to work out where they get cash from somewhere else to essentially buy off their spouse, whether their spouse has shares in the company or not. It goes on their side of the balance sheet. So anything that kind of reduces the value of their shareholding, particularly in a family company, they're not going to be the only shareholder. There will be other shareholders. So in that sense, I think everything is worth looking at in that respect. I appreciate it's not always the starting point when people set up businesses or get married, but divorce is sadly still fairly common, and it's worth considering.
Yeah, and like you said, if business grows and the float and IPO, it does get a bit more complicated, doesn't it?
It does. I mean, we still have divorce cases where it's clear that businesses are being built up for sale. And on that basis, the wife may end up with a percentage of whatever the husband gets from from a flotation or a sale of the company if it happens, say, within the next 5 years or something like that, because judges are very alive to the fact that a lot of businesses are maybe built up to a certain point for sale, or even if they just get to a certain point, and if you ask questions and have there been any offers, or have you considered taking your business to market, it's a very relevant factor on divorce. And obviously in a lot of people's eyes that then kind of magically inflates the value of the business, or the potential value, doesn't it?
Yeah, absolutely. And Jim, what kind of trends are you sort of seeing, with the clients that you're working with, or in the sector in general? I mean, one thing that I've noticed in the last 6 months, the number of exits in family businesses. And we had O'Connor's Utilities just last week that have sold to an investment company in London. It's been quite a few of them, quite a few mergers and acquisitions. And that's something that you're seeing as well?
Yes, generally across small and medium-sized businesses, whether they're family-owned or not, the M&A market has been busy, as everybody I think knows, for the last 2 or 3 years, really, and notwithstanding them. It's answering your question in a slightly different way. I think it's really important for businesses owned by families to decide if they are a lifestyle business, or they're growing for a capital event, or other. It's having a plan and not just drifting a lot. There's an organic nature to these businesses, as John alluded to earlier, and often the plan will evolve over time. But I think it's really important for businesses that are small and medium sized, and particularly family owned, to decide what they're trying to achieve and when. And then as a byproduct of that, to decide who in the business is contributing what to that end. And by that, I'm alluding to the fact that a lot of people in family businesses are wearing several hats. They are the shareholder and the employee and and it's not always healthy for somebody to be wearing all 3 hats. It's quite often the case that Grandad will have set it up and be all things to all people when the business is getting going. But when you get to a next generation, or a business that's much more evolved, it can be very useful to have a more evolved structure. And Tom alluded to this as they've implemented some of these changes in their business, because otherwise the overlap between external shareholders, family shareholders, employees, directors can get blurred and can cause a lot of confusion, and then that can undermine the operation of the business. But sorry, a simple answer to your question: yes, there's a lot of M&A activity in family businesses, but it can be a sensitive subject, because as with all self-made businesses, growing it and then handing over the keys to an external buyer can be quite a wrench, and that's a whole different discussion about how to navigate that process psychologically for someone who's growing the business.
Yeah, do you think that's being driven by the current economy at the moment? They've gone through quite a ride over the last 2 years, and with rising inflation, supply chain disruptions, it's just like, let someone else now look after it, because we've been through enough of a challenge.
I think there's something in that, Shalina, definitely. I think when the pandemic first hit, everybody put the brakes on decision making in business generally, including whether to exit and create a capital event, because they weren't sure what was going on. I think in a very general nature now, everybody's got used to uncertainty as the new norm, and there's so many challenges facing the economy and business all the time. So I think a number of business owners have decided the time has come to create a capital event, because we're in an uncertain world and it's not going to change, and we may as well get on with it. And so we had a pause in M&A activity for a period at the beginning of the pandemic, and then it's been fairly steady since then, partly I think because people are looking to just get out. Yeah. Mm-hmm. And also, sorry, there's a lot of private equity cash out there driving transactions, and that's still the case, and so there's an appetite in a lot of sectors for M&A activity.
Absolutely, and the Northwest is quite a buoyant market for that, isn't it? Yeah. And John, are you seeing something similar as well?
Yeah, we are. It's I think actually the whole thing about business owners may actually go back to the financial crisis. So, and there's tax elements to it. There's always tax elements to it. Way back then, there was taper relief available, so you're getting a 10% rate of tax. And then there was a financial crash, and a lot of businesses lost value in that. And these guys kind of like no longer getting the 10% round. And the early days, then entrepreneurs relief went up to 10 million. But for those early days, it was 1 million. So these guys are kind of like, right, business value down, my tax rate is 40%, and I've got to stay here and rebuild, right? And they did. And then they had a pandemic. And it's not all over the place, but there are a lot of battle weary business owners out there who kind of like, we've got 10 million entrepreneurs relief, and then it's been bashed down to 1 million. And there's a goodly number of them who want out or want to do succession. There's a vast number, actually, and you don't usually see this because people don't like talking about it. There's a vast number of people doing inheritance tax planning where they haven't done it before, due to levels of uncertainty. So I'm not just seeing M&A activity. I'm seeing people looking at the family businesses particularly and restructuring them to put them in a better position to manage their wealth, to move on the trading aspect if they want. That there is more thought by a number of businesses going into their planning at the moment.
Thanks, John. And Tom, I know you spoke about the restructuring on your side. What are your plans for the future for the family business you're in at the moment? It's not a lifestyle business. We know that it's a business that's been going 60 years and it's got legacy behind it.
Yeah, I mean, I think our plan is to continue growing the business, because we weren't actually we actually did some acquisition activity during the pandemic, rather than be the subject of. So we want to keep growing the business. We see it. We want to make it fit for the next generation. That's the sort of vision that unites me and my sister, and make it into as good and as purpose driven as a business as it can be. That's fit for this the world that we live in now, which is rapidly changing and is increasingly volatile.
Thanks, Tom. And John, Jim, and Fiona, we've talked a lot about making sure your plans are in place, your agreements are in place. There's one thing that you would like to tell family businesses who are watching this today. What would that be? Fiona, I'll start with you.
I suppose I come at this from such the wrong end of it, don't I? But I do think I think the thing about family businesses is, I think from my perspective, from a divorce perspective, I think things like shareholders agreements and that would be a very important thing to have. And I think also to kind of bear in mind that the impact that a divorce can have upon a business. I know that's not really in anybody's mind when they get married, but obviously people like me make a living because people do get divorced, and on that basis it's a real factor that should be considered, even if it's not a main priority of a business. But I think often shares are put in wives' names, I think often because people like John say it's tax efficient and things like that. But then if you have to transfer shares back as part of a divorce, there's often capital gains tax payable and things like that. So there's a lot more to unravel at that stage if that's what you do, if you do get divorced. Now, as long as people go into it and are aware that they're the potential consequences, well, then that's fine. But often people are a little surprised about how the whole thing can unravel if you divorce.
And I guess you shouldn't be scared of having that conversation, because just because you're having a conversation about divorce doesn't mean you're going to get divorced.
No, this is true.
And Jim?
I think the imposition of shareholders agreements is an obvious one. It doesn't have to be hugely complex. It doesn't have to be costly. All being well, you spend a bit of time putting something down on paper which sets out what happens in potential future circumstances, and you put it in a drawer and you never look at it again. But if you don't do it, you can get caught out, and small businesses can be very badly damaged by the lack of direction and a rule book when things go wrong, when people disagree. So that's the obvious thing to say, and that's where a corporate lawyer would come in. But the other thing I would stress, which isn't really a lawyer's thing, is in our own business and every other small business we advise, have foster a shared vision, write it down, have an idea of what you're trying to do and the cultures and behaviors which underpin it. A lot of people, I think that sounds a little bit fluffy and pointless. It's not. It's and it's something that you should do and go back to over time in every small business, in my view.
Yeah, John.
From my point of view, it's don't assume that you know your tax costs and get the knowledge you need to understand your tax costs. Some of the biggest mistakes I've made, I've seen being made, often when it's too late, is there are very specific definitions of what constitutes a trading business and what constitutes an investment business for tax purposes. Having a family business where you bought a little bit of property you rent out and made some loans out to people can change your business from being trading to being considered an investment business. That means you lose your entrepreneur's relief. In a worst case scenario, it means the business is subject to inheritance tax, and that can require 40% of the value of the business being handed over to the revenue. So it's just be aware of your position and your costs, and as a result, then you can make more informed decisions as to how to structure your affairs.
Thanks, John. And finally, Thomas would ask, you were a lawyer, came into the family business. What has that meant for you to be part of that journey now?
Yeah, I think it's been overall, it's been obviously an amazing, brilliant decision and a great journey. But I think, obviously it has benefited the business, in the sense that we have sort of fast-tracked, tried to catch up ground on all the stuff we've been talking about today in terms of the structure. And I did say, it's not easy. I think behind every sort of successful business in this sphere, or people who've done this, there's been obviously difficult decisions made and difficult conversations. But I think the thing that I would finish on is that, it can feel quite lonely. You often say, business owners can feel lonely, but you're not. I think if you surround yourself with the right advice, these difficult conversations can become, an enormously easier to handle and to deal with. It's not just, it takes out the personal element that I think, family businesses can often struggle with, the personal battle. If there's trusted advisors there, then that can kind of forge your way forward. But I think, setting aside some time and funds within a business to do that is something that I would, wholeheartedly recommend. And that's something that I've learned on my journey from being in a family business now for 7 years.
Thanks, Tom. Yeah, it sounds like having those difficult conversations earlier on and putting plans into place is going to benefit everybody in the long term. And thank you so much for joining us today. Thank you so much to our brilliant panel for your insight and advice. There will be a follow-up feature on the business desk following this webinar, and there'll be a copy of this video as well if you want to have a look. And thank you again, and thank you all for your time.
Thanks a lot.
Thank you.
Thank you.